Good morning students, I welcome you all for the online class of business studies. Today we will be continuing with the business finance topic. As yesterday's class I was explaining to you dividend decisions and the factors which are affecting dividend decisions, which has to be kept in mind while keeping the factors or affecting dividend decisions. The last three has been left out, which I will be going to start now. I will be taking taxation policy once again. From there I will be starting the next 10. Taxation policy, when we have said how it affect the dividend decision. This factor affect the decision has when the tax rate will increase, when the rate is high. Definitely at that time dividend cannot be paid off high, because government whatever profit we are earning, a part of that will be paid as tax. Okay, and when we are paying to the shareholders the dividend, that dividend is not deducted from the income earned by us. Because of that, whatever dividend will be paid, it will be of low rate. When your tax rate is low, definitely that situation company can think of paying high dividend rate. So that only taxation policy is there. If tax rate is higher, then company prefers to pay less in the form of dividend. Whereas if tax rate is low, then company may declare higher dividends. Access to capital market consideration. Whenever company requires more capital, it can either arrange it by issue of shares or debentures in the stock market, or by using its retained earnings. Raising of funds from the capital market depends upon the reputation of the company. If capital market can easily be accessed or approached, and there is enough demand for securities, that is the shares of the company, then company can give more dividend. Means when the share price is more, people are ready to purchase the shares of the company. There is a high demand of the shares of the company. That time company can think of higher rate of dividend. But when your company's share demand is less, it is difficult for company to approach and access capital market. Then company declare low rate of dividend and use reserves or retained earnings for reinvestment. When your business is not getting enough capital from the market, not getting enough borrowings from the market for raising the capital, definitely you will be using the retained earning. That retained earning can be formed when a part of surplus profit will be stored in the years and years for the company's expansion of the business, for capital formation of the business, more capital for raisement. So definitely that time you can have the retained earning as a source for reinvestment. Legal restrictions, student. When we take this factor about dividend decision, Companies Act has given certain provisions regarding the payment of dividend that can be paid only out of current year profit or past year profit after providing depreciation fund. In case company is not earning profit, then it cannot declare dividend. Apart from the company's Act, there are certain internal provisions of the company has enough flow of cash to pay dividend. The payment of dividend should not affect the liquidity of the company. So that is the legal restriction, student. When the company is restricted that they cannot increase the dividend at a certain level, then definitely they have to be in a limit. So Companies Act has given certain provisions regarding payment of dividend that can be paid only out of that current year profit, not or past year profit after providing depreciation fund. In case company is not earning profit, then it cannot declare dividend, and that situation Companies Act, there are certain internal provisions of the company, that is whether the company has enough flow of cash to pay dividend or not. Contractual conclusions, students. When we see contractual constraints, when companies take long-term loans, then financial may put some restrictions on constraints on distribution of dividend, and companies have to abide by these constraints. That is known as contractual constraints. So these contractual constraints, according to that, when companies take long-term loans, they have to take financial decisions. They have put some restriction on constraints or distribution of dividend in companies. Stock market reaction. The declaration of dividend has impact on stock market. Has increased dividend is taken has a good news in the stock market, and prices of security rises. Whereas a decrease in dividend may have negative impact on the share price, as those companies whose dividend rate is not high, people are less interested to invest in that company. So possible impact of dividend policy is the equity share price also affect dividend decisions. So that is the stock market price. Financial planning. The next topic after these three important decisions, and the factors how these decisions are taken, we are having a next topic, that is financial planning. What do you mean by financial planning, student? The planning which is needed to be taken, all the decisions which is needed to make the financial decision, it is known as financial planning. The thinking by what way we can make the finance to be arranged, the thinking how it has to be utilized, the thinking how it has to be saved for the future period of time, it is known as financial planning. So financial planning in short means deciding in advance how to spend on what is spent according to the funds at your disposal is known as financial planning. In the words of Gestenberg, financial planning includes determination of amount of finance needed by an enterprise to carry out the operation smoothly, determination of sources of funds, that is the pattern of securities to be issued, determination of suitable policies for proper utilization and administration of the funds. The financial planning begins with determination of total capital requirement. For this, the finance manager do the sales forecast, and if the future prospect appear to be bright and expect increase in sale, then firm need to increase its production capacity, which means more requirement of long-term funds, higher level of production, and increase in sales will require higher fixed as well as working capital. So that is the point, students. Financial planning always includes three important decisions: determination of amount of finance needed by an enterprise to carry out the operation smoothly. Second, determination of source of fund, from which source we will be taking either the borrowed or the owner's fund. Determination of suitable policies for proper utilization and administration of the fund which we have taken. That is the decision which we are taking in financial planning. The financial planning begins by what way? As I said, as I read, determination of total capital requirement. First we will decide in planning what is the total capital requirement for the business. For this, the finance manager first we will be doing the sales forecast, and in the future prospect appear to be bright and expect increase in the same. Then firm needs to increase its production capacity so as to increase the income, which means more requirement of long-term funds, higher level of production and increase in sales. The same story, that is the vicious circle of funds investment and the productivity increase, and then the profit increase, income increase, saving increase, then investment will increase, and again the investment increase, productivity will increase. After estimating the requirement of fund, the next step of financial planning is deciding how to raise the fund. There are various means of raising the fund. There are preference shares, debentures, equity shares, mutual funds, many things. Company have to decide. They want to increase the shares capital in the form of owners or on the borrowed fund. Financial planning is broader in scope as it does not end by raising estimated finance. It includes long-term investment decisions. In financial planning, finance manager analyzes various investment plans and select the most appropriate. Finance manager make short-term financial plan called budgets. Objectives of financial planning. When we see objective of financial planning, it is very clear, student. Financial planning is done to achieve the following two objectives. Very first, to ensure availability of funds whenever these are required. The main objective of financial planning is that sufficient funds should be available in the company for different purposes, such as for the purpose of long-term asset, to meet day-to-day requirement, expenses, etc. It ensures timely availability of finance. Along with availability of financial planning, also tries to specify the sources of finance, to see that firms does not raise resources unnecessarily. Excess funding is as bad as inadequate or shortage of funds. If there is surplus money, financial planning must invest it in the best possible manner, as keeping financial resources idle is a great loss for an organization. Financial planning includes both short-term as well as long-term planning. Long-term planning focuses on capital expenditure plan, whereas short-term financial plans are called budgets. Budgets include detailed plans of action for a period of 1 year or less. Importance of financial planning. When we see what is the importance of financial planning, sound financial planning is essential for success of any business enterprise. It is felt because of the following reasons. Very first is facilitate collection of optimum funds. The financial planning estimates the precise requirement of funds, which means to avoid wastage and overcapitalization situation. Second, it helps in fixing the most appropriate capital structure. When your financial planning is good enough, funds can be arranged from various sources and are used for long-term, medium-term and short-term. Financial planning is necessary for tapping appropriate sources at appropriate time, as long-term funds are generally contributed by shareholders and debenture holders, medium-term by financial institutions and short-term by commercial banks. So which will be the most appropriate capital structure formation that the firm has to decide in financial planning. Financial planning helps in investing finance in right projects. Yes, when we are pre-planned, we can know which project is better for us, which project is having more income for us. So financial plan suggests how the funds are to be allocated for various purposes by comparing various investment proposals. Helps in operational activities. The success and failure of the production and distribution function of business depends upon the financial decisions are right. Decisions ensure smooth flow of finance and smooth operation of production and distribution. Base for financial control. Financial planning act as a basis for checking the financial activities by comparing the actual revenue with the estimated revenue and actual cost with the estimated cost. Helps in proper utilization of finance. Finance is the lifeblood of business. So financial planning is an integral part of the corporate planning of business. All business plans depends upon the soundness of financial planning. Helps in avoiding business shocks and surprises. As we have pre-made the financial planning, definitely in the business, if any losses are there, we will not get further loss, any shock and surprises. We will be pre-ready for getting that type of things. So that means pre-ready means not to get that loss. If that loss will occur, then how to tackle with that problem, how the finance has to be arranged, what will be the source of finance at that moment, that will be ready. So by making financial planning, by anticipating the financial requirement, financial planning helps to avoid risks, shocks or surprises which otherwise firms have to face in uncertain situations. Link between investment and financing decisions. Financial planning helps in deciding debt equity ratio, and by deciding where to invest this fund, it creates a link between both the decisions. Helps in coordination. It helps in coordinating various business functions and has production, sales functions, etc. It links present with future. Financial planning relates present finance requirement with future requirement by anticipating sales and growth plans of the company. So these are the various importance of having financial planning, and we can decide what the financial plan we can do, how the financial planning can be done. It helps in investing. Once again, if I want to recall you what the financial planning importance is there, you can see the points one by one. It helps in operational activities. It helps in investmenting finance in right projects. Base for financial control. It helps in proper utilization of finance. It helps in avoiding shocks and surprises. It helps in coordination and link between the present and the future. It facilitates collection of optimum fund. So these are the various importance, and these are needed. Because of that, financial planning has to be done by every businessman. Every business houses, they have to do the financial planning. Otherwise, it can't be tackled. Comparison between financial planning and financial management. When we see financial management and financial planning, the difference is this. Very first difference is that it refers to efficient acquisition, utilization and disposal of surplus for its smooth flow of an organization. Second, financial planning, when we see, it refers to estimation of capital required and deciding the source of fund and optimum utilization of fund. Financial management includes financial planning. A strong financial planning will help to make the management to done its work. So it refers to all the activities which are related to the finance, whereas financial planning is only the activity making plan for deciding in advance how to make the finance to be arranged for the business. Financial management is wider in scope. Financial planning as compared to financial management is narrow in scope. Financial management, its objective is to manage all the activities related to finance, whereas financial planning, its objective is to ensure availability of funds and to see that the firm does not raise the funds unnecessarily. That is the financial management. Capital structure, the next topic, student. The capital structure, when we say, capital structure is the structure of the economy where we decide means the proportion of debt and equity used for financing the operation of business. Capital structure equals to debt upon equity. In other words, capital structure represents the proportion of debt capital and equity capital in the capital structure. What kind of capital structure is best for a firm is very difficult to define. The capital structure should be such which increases the value of equity share or maximizes the wealth of the equity shareholders. Debt and equity differs in cost and risk, as debt involves less cost but it is very risky securities, whereas equity are expensive securities but these are safe securities from the company's point of view. Debt is risky because payment of regular interest on debt is a legal obligation of the business. In case they fail to pay debt, security holders can claim over the assets of the company. And if firms fail to meet the return of principal amount, it can even on a liquidation and stage of insolvency. So further I will be explaining in the next class about the capital structure and financial leverage, the difference between both of them and everything. Thank you for today's class. Have a nice day.